Hello, accounting students. This is your teacher Roy with the first video of our semester for chapter number one. We'll probably have two or three videos for each chapter. And in this case, make sure you also read the textbook. Yeah, this lecture doesn't replace reading the textbook. And if you're not my students, you can always buy this textbook, Financial and Manager Accounting by Weil at McGraw-Hill. Let's take a look at the importance of accounting and also see who are the users of accounting information. To be able to make business decisions, we need to have accurate and reliable financial information that needs to be communicated to us. But before that information can be communicated, it has to be first recorded and summarized and then given to us so we can make our decisions. But in this recording process, what we're recording are business transactions. So we're going to see an accounting system to summarize that transactions and then to generate reports so we can make business decisions. The users of accounting information can be divided up into two groups. One group is called external users, people generally outside of the company. And this is going to be our focus for this semester in our Accounting 201 class, preparing financial reports or financial statements here for the owners of the business, here for shareholders of a corporation. They're not considered to be part of the business. They're external users of financial statements. Now, maybe using that information to determine whether they should invest in our company or not, or keep investing in our company or not. Here we have creditors or lenders extending loans to our company, making sure that we can repay back the amount we borrowed plus interest. To check the financial reports given to external users, we have a group of accountants called external auditors, or maybe the more common term is called CPAs, who audit the financial statements, who audit the financial system of our company, making sure those reports are accurate and reliable. Here it mentions that managerial employees could be external users. I think most employees are considered to be internal users. So maybe this is more like of a employee union who is interested in the financial position and profitability of our company. And of course, the government is interested in our company. The infamous Internal Revenue Service wants to make sure we pay our taxes properly. Or we'll learn about the Securities and Exchange Commission, interested in the buying and selling of stocks and securities of our company. In the case of internal users, we'll emphasize that more next semester in our Accounting 202 class, where we're going to be generating reports for, in this, as you can see, a lot of managers making decisions, which could range from the top president or CEO of the company down to the individual employees of our business. Here it mentions that accounting is called the language of business. To talk business, to understand business, you got to understand accounting, no matter if you're an accountant or not. And accounting has lots of different subtopics, sub areas. Here you can see it's divided up into four different groups. Even those that are not, again, accounting related, are accounting related, but not in accounting, like marketing here. They need to have accurate and reliable decisions to make marketing decisions. My favorite is this taxes here. I specialize in income taxes. This term here, private accounting, is generally any business that has accounting needs. Now, I mentioned the term CPAs or external auditors. That's called public accounting. Here they're doing the auditing of the financial statements or preparing tax returns or giving tax plans or advisory services like installing accounting systems. More and more, we're seeing the term artificial intelligence or data analytics or big data, including other technologies like crypto, uh, cryptocurrency. All of this is accounting related. Yeah, so as you learn accounting, you can even apply all this latest type of technology. It mentions here data analytics and data visualizations. In your homework, you actually will see some of this being applied in Tableau dashboards. Um, let's talk about ethics and the rules for accounting called generally accepted accounting principles. We cannot teach you how to be ethical. We can make you aware of being ethical, and hopefully, you choose to be ethical. Here you can identify ethical concerns, not just for yourself, but any stakeholder in a transaction or for a business. And then you got to know the consequences of your decision. And hopefully, you make the correct decision here to be ethical. At certain points in your career, I'm assuring you that you're going to have to make certain ethical types decisions that will not just affect yourself, but all the people around you, including your family. And we try to analyze our situations here called the fraud triangle by seeing opportunities to commit fraud. So, as much as possible, we try to limit opportunities so people don't get tempted in the first place. For example, you just don't lay cash out for people to pass by and grab, right? You lock up that type of asset to secure it and making sure that it's only accessible to authorized personnel. When people commit fraud, they try to rationalize their behavior, like, oh, other people are doing it, or I'll pay back the money. You know, rationalization, and of course, people commit fraud because there's some type of pressure, financial pressure, or even greed. Right? It's a pressure. Okay, so we analyze fraud using this triangle. And here again is that term for accounting rules called Generally Accepted Accounting Principles, or the acronym is called GAAP, GAAP. And the main organization that generates accounting rules, or GAAP, is called the Financial Accounting Standards Board, or acronym called FASB. Another group that creates accounting rules is the government itself. Here, the Securities and Exchange Commission is generates rules for companies that have their stock or other securities traded on exchanges. The main rules we follow is GAAP. Okay, in our class, the U.S. United States generally accepted accounting principles. Other countries may follow a global organization called the International Accounting Standards Board, and they generate accounting rules called IFRS, International Financial Reporting Standards. And the rules for international standards and GAAP are very similar, okay, but we're going to be focusing on GAAP in our class. The rules should be objective as much as possible versus subjective. And we want to make sure that the numbers are accurate and reliable. We're going to be preparing financial reports called financial statements. And we'll see lots of different terminology as we go through our class preparing these financial reports. And one of the big issues is when do we report? Here they use the word recognize the amounts on those financial reports. And how much should we report? Here called measurement. And the rules can be divided up into these three different groups here. I'm not concerned whether you can classify them into these three groups. Just be able to know what the rule is and to apply it to the different situations we come across in our class. So here's like four different rules. This one is called the cost principle. So whenever you buy something, you should be recording it at its original cost and not necessarily at how much you think it's worth. There's always exceptions to rules, but this is the main rule we follow. Whenever we pay or buy for something, we record it at its original cost. Another rule is when we report the income or here revenue we earn. The word recognize is maybe another word for reporting. When do we report the revenue? Is it when we collect the money? Is it when we earn it, even though we didn't collect the money? And how much should we report, the dollar amount? Is it set? Is it flexible? Do we need to make an estimate? And to make money, revenue, the term is we got to spend money or here incur costs. And now, when do we report that costs? Here it says we should report it at the same time the related revenue is reported. We call that the matching principle. We match up expenses to be reported in the same period, be it a month or year, or at the same time the related revenue is reported. And we're eventually going to take the difference between the revenue and the expenses, and that difference is called profit or net profit. You may hear a lot in the financial news the term profit. In our class, we usually use the term net income when we take the difference of revenue minus the expenses. And we want to be able to disclose enough information to make that information useful to the users of that information. Here, the concept called full disclosure. When we prepare the financial reports of a company, we're going to assume that it's going to be an ongoing business. It's not going to stop. It's not going to go into bankruptcy and stop. Yeah. But if it is for sure going to go bankrupt, or you think it's probably going to go bankrupt, then the rules may change. Yeah. You don't have a going concern assumption going. And then we have to report our amounts in money. Of course, it's going to be in US dollars. But if you deal with companies outside of your of the US, you know you're going to have to deal with their currency, like a euro or a yen. And just because you have to exchange money into another currency and hold maybe that other currency, you actually can make money or lose money. And that's an advanced topic that's not covered in a class. Yeah, but we're going to assume that we're doing things only in US dollars and we're kind of ignoring inflation or any conversion into a foreign currency. And when we prepare financial statements, we need to prepare it for a period of time. It's not just going to be continually going. We have to have a cutoff now to be able to compare one period, let's say, with a previous period. Yeah. That's the main reason why we need to have periods to be able to compare how well we're doing or not doing. And then when we prepare financial reports, we're doing it for a business entity. We tend not to mix up entities together to generate reports unless it's some type of big conglomeration of companies that have, let's say, a parent and their subsidiaries combined together. Here it mentions that the owner of a company is a separate entity from the business itself. Yeah, so you don't combine the business and its owners' um, transactions together in one report. You keep them separated. Talking about entities, here is four different types of entities that you may come across. Now, we're going to be concentrating in our class in the corporate entity, although probably the most common type of business entity now is a limited liability company. I have linked in our um, Laulima resources folder examples of this limited liability companies being formed. Let me show you some examples. This is from a publication called Pacific Business News, and it has some new businesses that were formed, 4 to 500, in this past week. And it's listed alphabetically by the city where it's located and then alphabetically by the company name. And as you can see after the name, most of them are limited liability companies, yeah, LLCs. Even ones that are organized and now registered to do business in Hawaii, like this from Virginia or Georgia. Here's a corporation where it ends with the company name of Incorporated Inc., yeah, versus LLCs. Again, the more common type of business entities are LLCs. Here's another Inc., yeah, mostly LLCs. But we're going to be covering corporations here in our Accounting 2-1 class. Yeah, corporations. Again, this is the more common type of business entity. Now, the simplest type of business entity is a sole proprietorship, meaning you have just one owner. That's not a corporation. You could have a one shareholder corporation, but here this business is unincorporated. And you could have many employees working for this sole proprietorship. The sole proprietor, the owner, cannot be treated as an employee of his or her own business. Yeah? And the main disadvantage, I guess, of this sole proprietorship is that if something goes wrong, if there's business liabilities that cannot be paid off by the business, the owner is going to be liable for that type of business liability. Now, if you have more than one owner, that is not a corporation. That business is going to be treated as a partnership. You hear two or more owners, and you're not a corporation. Here you're going to have that unlimited liability again, like the sole proprietorship. In either case, the sole proprietor or the partnership, these types of entities do not pay income taxes. It's the owners, here the sole proprietor, or the partners of a partnership that have to pay the income taxes for the business. And now again, we're studying corporations. You could have one shareholder or thousands of shareholders. And this type of business would pay taxes, income taxes, versus partnership or sole proprietors where the owners pay the taxes directly. To be the owner of this corporation, a shareholder, you also can be treated as an employee of the business, unlike a partnership or sole proprietorship. Now, going back to the most common type of business entity, limited liability company, if you're an LLC, more than likely you'll be treated as a sole proprietorship if you have only one owner, or two or more owners of a limited liability company, you'll be treated more like a partnership. Here, the owners are called members. So even though you see a separate entity here for LLCs, more than likely you would treat them as a sole proprietorship or a partnership depending upon the number of owners. And the benefit now of a limited liability company is that just like a corporation, the liability is limited to the business and not to the owner. Yeah. Corporation, the business liabilities are limited to the business and not the owner. But keep in mind, if you're a small business and you're trying to borrow money, I'm not going to lend it to you if you don't guarantee, you, the owner, the stockholder, or the member here, don't guarantee those business liabilities to be paid off. So even though they emphasize here unlimited liability, there may be some exceptions to that. Again, we're studying corporations versus LLCs. Now, the way to be a corporation, to become a corporation, you have to be recognized by some type of government entity, usually by a state government. Here in Hawaii, The department that takes care of that type of licensing is called the Department of Commerce and Consumer Affairs, and specifically their Business Registration Division. So you can do this online. You can become a corporation to get incorporated or to become a limited liability company by going to this website. Technically, to be a sole proprietorship or partnership, you don't need to file, but you usually should to be recognized as a business entity. A little more accounting rules. To set up an accounting system, you should make sure that the cost of running that system is giving you the benefits that you need. For example, as small as, let's say, a one person operations, part of their work is to do accounting work. Or in a multi uh, international company, you could have departments just doing accounting work. But you got to make sure the cost of running that accounting work, the time and effort you put into that accounting work, is giving you the enough benefits to have that accounting work done in the first place. Here's a rule called materiality. What's material to you, important to you, may be immaterial, unimportant to me. It depends just on the size. In our class, $1 off is a material mistake. It's important to get accurate and exact numbers in the work we do, just to emphasize how important accounting is. But if you look at the financial reports for a multi-billion dollar company, being $1 off, maybe being $1,000 off or $1 million off is not significant in making decisions for the users of that financial statement. So again, it's all relative, be it material or immaterial. You don't want to waste time on something that's immaterial. And accountants are known to be conservative. And maybe the best way to kind of explain conservatism is what it's not. We have things called assets, things that the company owns, assets. And what we want to do is not overstate the assets, show too much. That doesn't mean you purposely understate them, right? But you don't want to overstate your assets, and you don't want to overstate the money you're earning called revenue that we saw before. Again, you don't understate revenue, but definitely you don't overstate it. And likewise, the opposite of an asset is the liabilities you owe other people. And you do not want to understate them. Same thing with expenses. To be conservative, you do not want to understate your expenses, and that's trying to be conservative. Okay, let's stop here for our first video, and when we come back, we'll take a look at something called the accounting equation and how we can use that to record business transactions.